This is not that. This is going to cause a lot of problems from a purchasing power point of view. I think the risk of recession has gone up dramatically as purchasing power is dropping dramatically. In the U.S., the consumer saving rate already is down to levels we have not seen since 2013.
The founder and CEO of ARK Invest, Cathie Wood, said on Monday that the risk of recession has gone up dramatically in an interview with CNBC International TV. ARK Invest has been the talk of Wall Street over the past couple of years, outperforming the market and solidifying its place among the big players in the investments world. Wood is the founder and head of this investment house, and many have compared her rising star to the likes of Warren Buffett. Europe's economy is likely already in a recession as a result of the Russian invasion of Ukraine, and the U.S. economy may not be far behind, which will likely prompt companies and consumers to look toward technology to lower costs. Cathie Wood, whose ARK Innovation Fund outperformed all other U.S. equity funds following the coronavirus lockdowns in 2020 before stalling in February 2021, said that soaring oil prices should accelerate the transition to electric vehicles, while genomics companies should benefit as a form of cost saving compared to existing forms of treatment. The good news is that innovation solves problems, Cathie Wood said. Cathie Wood's optimism comes as her flagship ARK Innovation Fund is down 38.6% for the year to date as high inflation saps investor appetite for the high growth and low revenue companies that are mainstays of her portfolio. Her largest position, Tesla, is down 32% for the year to date, while streaming company Roku, another top holding, is down nearly 52% over the same time. In this interview, Cathie Wood shares her fears of a possible coming recession and how she is coping with the huge drop in her portfolio. Before we listen to Cathie Wood, please take the time to smash the like button. Thanks for all your support.
I wanted to ask you about some of the other markers in the market right now, particularly as it relates to the war in Ukraine. Have we seen peak market impact yet, and what should investors be focusing on here?
It's very hard to say if we've seen peak market impact. I know the markets are getting hit today. Typically, the way we see the peak is through the VIX, the volatility index. And it has moved up. It's in the mid-30s. I'm not sure what this morning is. And the shock in 2018 and the one before that got us into the low 40s. Of course, the coronavirus got us to 80. But we're getting close to those cathartic moments in the past. I would be surprised if we do go to the coronavirus levels, because remember, people were expecting a depression. The whole world shut down. This is not that. This is going to cause a lot of problems from a purchasing power point of view. I think the risk of recession has gone up dramatically as purchasing power is dropping dramatically. In the U.S., the consumer saving rate already is down to levels we have not seen since 2013. So that buffer that the stimulus payments created during the crisis, that's gone. And so consumers are probably going to pull back. Sentiment suggests they will. And in some ways they already have. If you average over the last 3 months, this is U.S., consumption in real terms has been pretty flat.
Let's talk about what's happening in the markets right now and what's happening in the fund, because, Cathie, it's been said that you are in the toughest battle of your career right now. Not only are you fighting against the market momentum, you're also trying to halt huge losses and outflows. So I want you to address this for us. What is the message to investors here? Do you think that the street is just getting you wrong, or is it time to concede that mistakes have been made?
So let's put in perspective. You mentioned 60%, which is absolutely right. We have been in a terrible bear market for innovation. Hard to understand, but terrible bear market for innovation. However, if you look from the bottom of the coronavirus to that peak in February of 21, we were up 358%. Why? Because innovation solves problems, right? Now we're down 60%. And we have a whole new set of problems, certainly coming out of Russia and Ukraine. If you look at our strategy over a 5-year period, look at the last 5 years, I'm not quite sure what the numbers are, but they are well above our minimum hurdle rate of return, which is 15% at a compound annual rate. And I think over 3 years, we're closer to 25%. So that helps put our performance into perspective. You know, this is a period, if you believe in innovation, and that innovation does solve problems. We had a preview of that after the COVID crisis, when our strategies in the span of a month, many of the stocks were taken down 75% because either they were burning cash or they had low cash cushions. But guess what? Those were the genomics companies that were going to get us out of the coronavirus. And today, what do we have? We have all kinds of problems, the latest of which is Russia, Ukraine, and all of the commodities coming out of that area, especially hitting Europe. I think we're going to be looking at a lot of demand destruction and substitution into innovation. Electric vehicles as opposed to gas-powered vehicles would be the biggest one. We also have labor shortages all over the place. Again, automation. This is innovation at its best, and it's being turbocharged by this environment as the market is really hitting our stocks. So I think if you were to look at the next 5 years, and if you were to give us that 5-year investment time horizon, we are the closest you'll find to a venture capital fund in the public equity markets. If you were to give us that 5 years, given our expectations for growth in these new technologies, I think we're going to see some spectacular return.
$4 billion would provide for a lot of retirements. It would, for example, cover the medical costs of about 21,000 retired couples. It's also how much investors have lost so far in the rising and fallen fortunes of star manager Cathie Wood's flagship ETF ARK Innovation. That's based on calculations by Morningstar. Wood remains undeterred, however. She says innovation stocks are not in a bubble, rather they have entered deep value territory. But Cathie Wood may have something up her sleeve as she is constantly reshuffling her ETF to stand up to market headwinds. Don't drift from your style. Just keep your eye on the prize. Truth will win out, Cathie Wood told investors during a webinar last month. We have the best research on innovation in the world, and I know the returns that we will generate for our clients over the next 5 years, if our research is right, are going to be spectacular. Can Cathie Wood bounce back in 2022? Cathie Wood continues to be an ace stock picker with a long enough winning track record to forgive the rough patch of buy and sell decisions this year. I wouldn't bet against her bouncing back in 2022. Thanks for watching. See you in our next video.